So let's say I'm a company, I borrowed debt at close to zero interest rates 18 months ago. Now I have to start thinking about rolling my debt. So instead of rolling my debt at close to 0% interest rate, today I need to roll my debt at a much higher rate, much higher than the 5% that the Fed is setting as the risk-free interest rate.
All right. Good evening, everybody. Thank you for dialing in today. We're back for our live market commentary session for the month of September. And this is where we talk about the latest developments in the markets. And this is where we share our views on them too. So I am Albert. I am the Deputy Country Manager here in Malaysia, and I'll be your host for today's session. As always, we have the pleasure of Stephanie, the Chief Investment Officer at Stashaway. Hi, Stephanie. How are you?
I'm good. Hi, Albert. Hi, everyone. Good to see you all again. It's like this time of the month where we provide our most updated thoughts on the markets.
Yes, indeed. And for today's session, let's dive right into the big event that happened last week, right? So last week we had the Fed meeting, and what came out of it was a hawkish pause. And what I mean by that is that they left the Fed interest rate at fixed at 5.25 to 5.5%, essentially unchanged. But what was very interesting is that they did indicate that there would be the prospect of another hike for the remainder of the year, and for the longer term, they were signaling less prospects of rate cuts. On top of that, they also penciled in only 50 basis points of rate cuts for next year. So this was in contrast to 100 basis points before. So not as much cuts as was expected. So with all this, with the projection from the Fed too was also showing that growth would be stronger, unemployment rate would be lower. Seems like the Fed itself, Stephanie, and they think that they're able to generate a soft landing or a no recession scenario. So the market doesn't seem to believe so. What do you think about that?
Yeah, I think that's been kind of the debate of the year that we've been having, and perhaps like the Fed is also having every time they meet, like how likely is the US going into a recession? Is inflation actually under control, et cetera, et cetera. So I think actually, what came out of the Fed, like kind of in terms of the decision itself, no change. That is not a surprise, as Albert mentioned. I think maybe what was like surprising the market a little bit is like how hawkish the Fed actually sounded. But actually, if we think back to kind of what the Fed was looking at, obviously, Powell referred a lot to data. And indeed, if we look at the US data, it didn't support a dovish stance from the Fed. So, for example, if we rewind kind of 2 months in our semi-annual outlook, we actually looked at some of the very long-term data or charts for the US. So in the outlook piece, just a quick refresher, we looked at the US economy and we concluded that it was very strong because employment rate is still very low. And still, that is still the case today. Unemployment rate in the US is still at historical low. And although there are some signs of the job market softening, still, the labor market supports a pretty strong consumer. And as we all know, the US consumer actually makes up a significant portion of the economic activities in the US. And therefore, when the consumer has money to spend, the US economy actually would remain quite strong. Now, what we also deep dived into in the outlook piece was looking at the two-speed economy. So when we think about the US consumer, they can buy goods, they can buy like iPhones, they can buy cars, or they can spend money in terms of going out to restaurants or traveling or hotel, etc. So the first category in terms of buying goods is stagnating because of the a lot of consumption happened during COVID when everybody was locked at home. You log onto Amazon, and being a US consumer, you just buy everything. So because of that pre-spent amount, we're not seeing any growth in terms of retail sales, for example, adjusted for inflation or even like goods, right? If you look at the latest, iPhone release, not a lot of people are excited about it. So that also tells you why Apple revenue have been falling year on year in the past 2 quarters. So that actually like creates a much weaker manufacturing industry for the US that has been going on for the past few months. Service side has been actually a lot stronger because of, number one, the revenge spending from the COVID lockdowns. So when everybody can go out, of course, like us included, you would go travel and spend on hotels or going out to eat. That revenge spending recovery is now mostly done. So I think what we're going to see in the next few quarters is that the service growth that we've seen in the past few quarters will start to slow down. And indeed, I mean, we're actually looking at the updated data from, I mean, just this past week. A lot of us actually, I mean, of course, we focus on the Fed, but actually for us, the more interesting data is the flash PMIs that came out. So just to dive a little bit deeper into that, for the US, the flash PMI came out to be, in terms of the overall number, composite number, it was 50.1. So this actually represents a 7-month low. As a quick reminder, when the PMI actually falls below 50, that indicates actually a contraction in activities. So we're kind of borderline there. And more importantly, I think for the service business activity, that number actually dropped to 50.2, which is an 8-month low. So indeed, the service side of things is actually slowing down. And manufacturing is still below 50, as was the case for the last few months. But interestingly, manufacturing actually seeing a slight pickup, but not enough actually to kind of offset the slowdown in service. So I think the data actually supports our thesis that we're going to see a slowdown in the economy, but because of the still very strong labor market, the slowdown is going to be much more long drawn, meaning that we're not going to see a crisis because there's no, I think if you look kind of across the economy, there's no imminent kind of risk bubbling up, unlike Silicon Valley Bank. And also, even if an episode like Silicon Valley Bank happen again, this time around, the Fed and the government is very, very quick to respond. So the risk of something like a Lehman Brothers crisis or financial crisis is very, very well contained. Instead, I mean, what we're going to get, and I think what the market is starting to price in, is that because of this kind of slower downturn in the economy, interest rates actually may stay higher for longer. And I guess if you look at the current market expectation, the market is actually expecting the Fed to start cutting interest rates middle of 2024, which has been a moving target. So, I mean, this is kind of take this with a grain of salt because the market actually changes its mind all the time. But it gives you a good idea of what the different markets are kind of pricing in terms of the path, like rate path expectation. So if US data continue to be fairly strong, and if like inflation actually doesn't abate as quickly, this timeline may actually get drawn out more and more. And if the interest rates actually stay higher for longer, or kind of like last for more than 12 months, that may start to pose some some more risk or some more problems for corporates. Because if you think back, so like a lot of these corporates may have shorter term debts. So let's say I'm a company, I borrowed debt at close to zero interest rates 18 months ago. Now I have to start thinking about rolling my debt. So instead of rolling my debt at close to 0% interest rate, today I need to roll my debt at a much higher rate, much higher than the 5% that the Fed is setting as the risk-free interest rate. So some of the businesses will have problems, and I mean we're starting to see some of that happening. So I think this is kind of what the market is trying to kind of grapple with, is what are the ramifications of a higher for longer regime. And of course, as investors, we need to think about that as well.
Yep. Thanks, Stephanie. You did touch on a few points in terms of our outlook, and for those of you who want to read more about our views on the remainder of the year, just Google up second half market outlook by Stashaway, and you'll be able to find the article that we written on it there. In the meantime, if you do have any questions on what we're talking about today, please feel free to post them in the chat box, and we'll get to it afterwards. With regards to the state of the U.S. economy, Stephanie, you mentioned that seems like the U.S. economy itself is isn't heading towards any kind of crisis situation. On one hand, we have seen interest rates being hiked up quite significantly over the past more than a year, and this higher borrowing cost is actually eating into the credit or the wallet of the normal consumer. On top of this, you have their savings being exhausted from the pandemic era days. You have other more specific instances like student loan repayments resuming. You have like the auto worker strikes happening, and also more recently concerns about a potential government shutdown in the US itself. And all these different factors could mean that households could feel a little bit more jittery, being squeezed from a financial angle in the fourth quarter and beyond. So what do you think about the state of the current households in the US right now? And does that amplify the risk of a recession?
Yeah, I mean, obviously there's a lot of headlines and concerns, like all these, I guess, like problems that Albert, you have cited. However, if you just look at, I guess, the household debt in total as a percentage of GDP, it's actually not that bad, or I should say it's actually improved quite a bit from the pandemic just a few years ago. So I mean, just to quote some numbers. So today, I mean, as of the second quarter of 2023, I mean, U.S. household debt as of GDP is actually less than 66.5%. This number was actually 69% at like kind of post-COVID. And also, if you compare this with like a 10-year history, today's household debt as a percent of GDP is actually at the lower end of this 10-year history. So I actually think that given still a very strong employment market, U.S. household is actually doing fine. If we think about for example, the property is actually kind of a source of wealth for a lot of households. Property prices are holding up okay. And also because a lot of these households are actually on 30-year debt, they don't need to roll their debts. So I think the U.S. consumer is not a big problem area that we need to be too concerned about. But actually, in contrast, I think the U.S. corporate is a kind of a segment that is kind of with higher concern. Why? Because number one, I think, as I mentioned, I mean, a lot of business models that may not be viable with a much higher cost of funding in the short term may get squeezed in the next 12 months or so. And then secondly, I think if you look at kind of wage increases, actually, I mean, wage increases have been like over 4%. So that's outpacing inflation or at par with inflation. And some of these companies may not be able to raise prices enough to cover the increasing cost of conducting the business. This includes raw material, this includes wages, this includes interest expenses. So I think for a lot of corporates, I mean, they may see their margins getting squeezed, and especially given very, very high current margin. I mean, the upside that these companies can get is quite limited, whereas the downside actually may actually start to kind of be a bit more apparent. And then also, lastly, I would say in terms of companies, kind of when they calculate their sales numbers, initially they would tend to benefit from inflation. However, as we get to more and more late cycle, companies actually start to kind of I guess see their profit margins eroded by inflation. So I think if I compare the household sector versus the corporate sector, I think we may see a period where the household is actually stronger than the corporate. So I think this is an area that we're paying quite a bit of close attention to, because if there is a kind of more significant slowdown, that could come from the corporate sector rather than the household sector.
Speaking about corporate margins, I just want to touch quickly on that. One potential factor that can have a pretty significant impact on it is oil. We've seen oil prices surpass the $90 mark, driven by Saudi and Russia continuing its production cuts when it was announced last week. And this can have a pretty sizable impact on corporate margins itself. So what do you think about that, and also the implications towards inflation?
Yeah, I think if you look at the oil prices movement in the past few months, I mean, basically recovered from about $70 to now $90. A lot of this is actually driven by supply constraints that are coming from the oil producing countries, meaning that they're actually the price setter. And I think with kind of most of the world slowing down, there's not a lot of demand pool for oil prices to go much higher. So I think if you think from a supplier perspective, because like higher prices actually start to destroy demand as well. So what the oil producing countries are trying to do is that they're trying to strike a balance between like prices and like volume. And I think the current range is probably the optimal range that would not destroy too much demand, because they know if let's say, I mean, oil prices, they push it up to 110 like tomorrow, I mean, that would destroy quite a bit of demand. So I think from a rational kind of perspective, there's not a lot of incentive for them to constrain supply a lot further. And I think but they would try to support prices, because like the GDP, like the kind of national income do depend on where oil prices trading. So they don't want oil prices to fall much below 70, but I don't think is they in their interest, economic interest at least, to let oil prices rise much above 90 either. So in conclusion, I think like we're in a range-bound market in commodities, in oil. Unless of course like there's geopolitical turmoil, but all these tend to be a bit short-lived. So I would think that like oil of course is a factor that we pay a lot of attention to, but I think the cycles are fairly short, and I think the economic implication of these like kind of shorter term movements is not that long lasting.
All right. We don't have any questions from the audience, but I think that pretty much covers today's session. We talked about the recent Fed pause. We talked about its implications on and other factors on the U.S. households and also on oil itself. With that, that's it for tonight. I'd like to thank all of you for attending today's webinar. Thank you so much, Stephanie, for sharing your views, and I hope you all have a good night.
Thank you, Albert. And yes, good night to you all. Thank you.
Take care, everybody. Bye-bye.
Bye-bye.